Thanks, Jerry. So it's my pleasure tonight to introduce David Blumberg, and he's going to do a talk. He's also very open to Q&A, so get your questions ready, and I'll run around with the microphones.
So, good evening, good afternoon. First, can everyone hear me all right?
Yeah.
Cheap seats, yes? Michelle, you can hear me? Excellent. Thank you, Dino. Thank you, Jerry. Thank you, AT&T. First, I'm learning to be socially media savvy, so if you're tweeting, please, hashtag AT&T Showcase, AT&T Foundry, also, David Blumberg, Blumberg Capital, and whatever monikers you're tweeting under. I guess entrepreneurs would be a good one for today. And let's get a sense of who's in the audience. How many of you are currently entrepreneurs with your own startup? I think it's 100%. That is awesome. Now I'm going to be afraid. How many of you are looking for capital? No, that's my job. That's my job. Right. That's very good. That's very good. Okay. And how many of you got funding already? Okay, well done. It's tough. Life is tough, and you are the hardy. And I appreciate the fact that you've taken your time to spend with me. I hope it'll make it worthwhile. So the rules of the game are, there is no such thing as a stupid question. So please interrupt me. And I do not have all knowledge. I can learn probably as much or much more from you in this dialogue. So please interrupt me, challenge me, throw it out.
And if you want to ask a question, please put your hand up and I'll get a microphone to you so we can get you on the recording. Tonight's talk is being live streamed. Thanks.
Is this to the San Diego part?
No, it's all over.
All over. Greetings, world. Bonjour. Bonsoir. All right, so let's start. And this is going to be talk a little bit about venture capital, and I'm going to use Blumberg Capital as a case study of what we do, and we're kind of a typical early stage venture fund. There are other kinds of venture funds. There are also angels, and maybe elucidate a little bit of the differences. And then talk a little bit broadly about some of the changes that have happened in the industry broadly, mostly in the IT space, which I know best. If you're in synthetic biology or clean tech, I know less about that and about hardware. And then want to take a lot of your questions. All right? So let's carpe diem. So we, and I think most VCs, like to think we do this. We try and help you. We don't control you, but we try and help you to scale your companies into large, successful enterprises. That's sort of the goal. And we're measured by money. We're measured by the returns that we can provide to our investors. This one, if somebody can figure out how to fix that little thing, it always does 2 slides at a time. Anyway, we at Blumberg Capital are 8 investment professionals, actually 9 today. We just hired a new person. And we have 700 employee openings in our portfolio. So if any of you have friends that are looking for jobs, get to know VCs. We have an incredible amount of job hiring right now. Most VCs have dozens of portfolio companies, and all of them seem to be looking for people, and in all parts of the world. We have companies all over the world. We are focusing very much on capital efficiency, so that leads us mostly towards software, but if you can pitch me on a hardware deal that's capital efficient or synthetic biology, we're open to hear it. We very much like to lead series seed and A, and that's because we think that's where the best opportunity set is. It's where the best disequilibrium of information is. And explain that later on, but basically, simply put, information, perfect information is an attribute required for true, fair, good capitalism, where prices merge up to their equilibrium status because there's a good amount of supply and a good amount of demand, and it has perfect information to have the clearing price. We like being at the early stage because most entrepreneurs only can kind of get in to see 3 or 4 VCs. And up at the late stage, everybody knows about all those deals. And so they get more arbitraged up to very high pricing. So we find that the best buyer prices are at the early stage. And also, that's the good thing for us, but the good thing for you is that we can actually help you a lot, make the pie bigger by adding some value, probably getting you early customers, which we excel at, recruiting for you. We have a new talent lead in our firm. And when I'm talking about Blumberg Capital, it's not just a commercial for us. I think a lot of our good peers, Founders Fund, First Round Capital, True Ventures, Soft Tech, Polices, all these good groups do similar kinds of things. We are unusual, however, I'll say that, in that we go beyond Silicon Valley. We don't think all the brains are here. Perfect example, coming from Australia via Ireland, is that it? Yep. And a lot of you probably, how many of you hail from other places than the US by birth? Fabulous, welcome, this is great. America's built on entrepreneurship and immigration, and we need more of it. And luckily we get you guys, the brightest of all of them, to come to our shores, and I hope we can keep you. and I hope we merit your staying here. Because there are a lot of attractive places to go back to now. We're starting to see the reverse of people coming here for education and saying, hey, no, I want to go somewhere else because there's better opportunities. And our governments better listen to that outward migration and try and keep people here, otherwise the tides will turn. So we've picked 4 hubs where we know the communities best. We know angels, we know entrepreneurs. So US, mainly San Francisco, New York, LA, Chicago would be our 4 hubs. In Israel, there's only really kind of one big city there, Tel Aviv. Germany, we're in pretty much Hamburg, Munich, and Berlin. And Canada, mostly in Vancouver with some outreach into Toronto. Okay, enough about that, let's go quicker. Here are some of our companies, and I'll use them from time to time as maybe a case study once or not. Does anybody know, let me try and be brave, anybody know any of these companies? Yes. Any favorites? You want to yell them out? Hootsuite. Everyone uses Hootsuite, that's great. It's used in about 190 countries.
I know zoos and Fortscale.
Awesome. You must be Israeli. Oh, you are, Dan Lebanon. That's right, nice to see you. Great. Yeah, we're blessed. It's getting easier to be a VC because we have such amazing entrepreneurs. And of course, we only showing them great successful companies here, but it's an amazingly good time. We've done a lot in our history was enterprise software and security. I was like the number 4 executive at a company from Israel called Checkpoint years ago. It sort of invented part of the invention of the firewall world, and got a lot of experience myself, and then helped other security companies. And so we now have Fortscale, which is one in that area. BioCatch, we sold last year Cyvera extremely successfully to Palo Alto Networks, right here in Palo Alto. Then in the social media area, a lot of you mentioned Hootsuite. Very interesting model because that was not possible, say 15 years ago. The whole SaaS model and their version of it, the freemium model, has really taken off and made your life a lot easier and our investor life a lot easier. I remember when I met Hootsuite, it was at the first Twitter conference, sponsored by a guy named Jeff Pulver, or many of you know. It was in New York, and it was interesting. They said, David, would you be on a panel? And I said, I don't know enough about Twitter. I'm like a VC. I'm not a social media guru. I said, but I know good companies. So Jeff said, well, go around and find some of the people who are showing on the floor and bring them up on stage. And so I said, okay, that's going to be my panel, and it's going to be my due diligence. So I got 5 entrepreneurs that I thought were pretty good, and I put them all up, and I let this great, geeky, techie Twitter audience fire away the questions. And I was like taking notes copiously. And out of that, Hootsuite sort of rose up to the top. At that point, they had 160,000 users, all free, no revenue whatsoever. And then slowly, we invested with Hearst Media, and then they added the premium model for small businesses, and then they added a lot more enterprise version model and started charging much more to the big enterprises, like the White House uses them, and Hewlett-Packard, and so on. And just to give you an example of how the sales model changed, remember in the old days, well, some of you got some gray hair, good. In the old days, like 15 years ago, you had to sell in the enterprise model. You go to the CIO, knock on the door, kiss the ring, and say, please, sir, would you like to buy a $2 million installation and have all this downtime and have to put all these resources on it and so on? It was a pain in the neck, and they said, well, we'd rather buy from Cisco and IBM. Tough for a startup. Today, and I'll give you an example of Hootsuite, we went to this chief marketing officer at Hewlett-Packard after we already had like a couple thousand people using Hootsuite products. And so it had bubbled up from the inside. And we were able to say, wouldn't you like to control what all these people are saying about Hewlett-Packard with the compliance module and management of timing and so on. So that was a brilliant way that a lot of folks are using now. So again, your life is easier that way, our life is easier. And that's in the B2B. Also think in the B2C. And Hootsuite's a crossover because it does both. But think about, 15 years ago there were no smartphones. There were no social networks. Now you have both. So what I say is we stand on the shoulders of giants now because we can get to billions of people that we couldn't get to before. And the nice thing, I was saying to people earlier, maybe the cake, not even the frosting, is that the world is getting richer at a really rapid pace. I'm going to have a slide on this. Right here. This is one of my favorite slides of all time. I didn't invent it. I think The Economist magazine did. But this is 2,000 years of economic history. I'll try to do it in 1 minute. Here's Jesus, amen, hallelujah. Jesus was a carpenter, right? He was a carpenter. So he was kind of a middle-class person. So his average salary would have been probably about $460 a year in 1990 inflation-adjusted dollars. Now, from the year 0 till the year 1800, people almost had no progress in their GDP growth. Nothing. Life sucked. In the first world, you died at about 43 if you were a man. In the third world, you died at about 27. We've tripled that in the third world, and we doubled that in the first world, just in the 20th century, 19th, 20th century. It's amazing how much growth we've had here. Now, what happened to this? What causes that kind of a hockey stick? That's what every VC dies for, that kind of growth, right? The world did this through capitalism. And it's not the exploitive capitalism that people talk about, it's the liberating type of capitalism. It's amazing, and here's what happened. Here, the world was really divided the 99 and 1%. So 99 and 1%. The 1% were the landowners. Whether you were a king, a duke, a Mayan prince, a shogun, a Chinese emperor, they owned all the land. And everybody else was a slave or a peasant or a serf, more or less. There were some little middle groups like clergy and doctors and these little weird middle people like Jews and Armenians that were the traders and so on. But most people were peasants. And so life was terrible. Now in 1800, around London and Amsterdam started two major movements, the bond market and the equity markets. And a few families, the Rothschilds, the Montefiores, the Saffords, a few of these other groups started trading assets and making loans that could move capital from where it was not needed and not getting a good return on the land to higher returns in the emerging enterprises of steam power and mercantile businesses and all that industrial revolution. So from 1800 to 1975, the growth around the world GDP per capita went up to 1.25% per year. Amazing growth. And people started living longer and getting taller and healthier and all that. And we got stuff like public health because people could pay for it and care about it, indoor plumbing. All this stuff made people's lives infinitely better. But from 1975 till now, what happened? Again, incredible growth, 3% a year. And I don't even have the new data, but I think it's stayed around then. And certainly countries like India and China have been growing much faster than that. Why? My little hypothesis, and some of you are probably economists, and I hope don't embarrass me in public that I'm wrong, but my theory is it has something to do with education and information transmission. Because there's sort of new growth economics. I think somebody named Bauer or somebody here, Solo maybe has created it, but new growth economics says, people say there was capital and labor. But I think now there's information. And information is not a reducible or depletable resource. A CD-ROM was copyable. Software is copyable. Books are copyable. And that information transmits, and it doesn't degrade what was there before, like a mine or a forest or something like that. So what we see here is incredible. I think the growth of communications transmission on information networks that have allowed the world to get smarter and richer and better for all of us. So that's why it's so exciting to be alive now. And when I say that, I always like to quote Martin Luther King, who was asked in the middle of the oppression of the Civil Rights Movement, Reverend King, if you could live any time, when would it be? Would it be with Jesus? Would it be with Moses? Would it be with Pericles? Would it be with Abraham Lincoln? And he said, the best time to live is right now. We are living in the best time now. It's always the best time now. Life has been getting better and better and better. And please don't let the press scare you into thinking the opposite. Okay, now, are we in a bubble? Let's go back to tactical stuff. We are here. This is a bubble. Note the difference? Okay. There is some bubble-ish stuff going on. I'll tell you about that. But this is how much VC was put in, way more than was needed. People came, I'll detract on my own profession. There was some extremely good returns. This was the dawn of internet, and things really started bubbling, and people said, oh, this is easy. And they saw a lot of models that had never happened before. They said, oh, we can make tons of money. So a lot of people, if I may say so, from not entrepreneurial backgrounds, if I may say so, from investment banking backgrounds, jumped into the VC industry and said, this is financial engineering. This is just a greater fool theory. We'll pop up these companies and foist them onto the stock market, take them public, and who cares what happens afterwards. That's not the venture model. I reject that model. I think all of you reject that model because most of you are probably engineers. And you know what the difference between an engineer and a marketer is? Engineers don't know how to lie. Marketers don't know when they're lying. I think I'm a marketer. Anyway, the problem is here that this is pretty normal. This is abnormal. And where I like to invest is at the seed and A round, which is down here, the blue. I don't know if you can see it. It's like infinitesimal as a portion of venture. So that's not in bubble mode, at least in the venture world. There's more money that's not reflected here coming from angels.
Yes,
but
just for That's adjusted for inflation, or?
I don't know that. Let me check. It's from PitchBook. You can verify while we're talking and come back to me. Okay? Next. That's a good thing about Google. You can check in real time. Here's another reason why I don't think we're in a bubble completely like we were in the past. Again, note the bubble, same time frame. This is an analogy. Okay? This is the technology stock as an index of the S&P as a percentage. Now, it has tripled in the last 15 years. Okay? That's because, as Mark Andreessen says, technology or software, he says, software is eating the world. It makes sense. So you should be rebalancing your portfolios. Portfolios should not stay static at a technology of 10% of your portfolio. It should be growing because that's what's happening in the US economy and it's happening in the world economy, right? Okay. Now, here's a more specific granularity of the bubble issue by stage. And again, why I love, and why I think you should love getting funded later, but I like to fund you down here, the bottom. These are the trends for funding prices of average million valuations pre-money at the seed and A round. And here's up in the D round and above. Question, Clarence.
Okay, so you're investing real early.
Yes.
Are you panicked about pro rata? See, because now with these later stage investors from the downstream putting tons of money in the later stage, you want to maintain your pro rata percentage. It's costing you to raise bigger and bigger funds just to do that.
Very sophisticated question from a very sophisticated entrepreneur who thinks he wants to maybe move to the investor side. Well, okay, that's a complicated question. I'll try and make a simple answer, and I'm probably missing some of the nuance. But here is the first part. What Clarence is talking about is once I invest, say, and own 10% of a company, and Blumberg Capital likes to actually own, we say go early, go bigger, go home. So we actually get like a stake of 15 to 25% right off the bat, and because we want to have confidence in you. We want to commit to you. We want to get married. We don't want to just do spray and pray. There are a lot of folks who do spray and pray, and that's fine, and they're good at it, but I know that I'm not that good at it. And we hit about maybe 1 out of 7, 1 out of 8 that are kind of unicorn potential. And so we need to own a lot of each one of those when they do hit. And I'll give you an example. We have a couple of unicorns in the portfolio right now. They're about to go public. It's super exciting. It'll make our investors, very, very happy, and do okay for us too. But the exciting part is that we got in down here. Now, a lot of people are still getting in here. This has some risk. Okay, you asked specifically about pro rata. So what he means by pro rata is, say we bought that 10%, say of the company right down here. Then in each of these next rounds, so there's seed A, B, C, D, and then there could be EF, mezzanine, IPO. To some degree, VCs will say we want to continue to hold our share. So that means we have to keep investing. If the first round was $1 million, okay, we put in $100,000. Then we want the next round is going to be $10 million. We might have to put in $1 million. The next round is $100 million. We have to put in $10 million. So on. And that is not exactly the right math because the valuations can change. But you understand. I'm not too upset about it. I think we did some learning in our earlier funds where we did not follow on as much. We did, I think, what we call asymptotic investing. And when we back tested and looked at all our deals, we said, hey, wait a minute. If we had actually sucked it up and paid the high price on our winners that we knew were winners, and outside VCs were coming in at very high prices and paying up, and we sort of said, whoa, too high, we'll back up, because we were used to buying 10% of the company for $1 million. Now our $1 million would buy, 1% of the company. We said, oh, that's too expensive. We were wrong, because we still had a chance to make 5 or 10 times our money from there. So, model what we did in our new fund, which is $200 million, we've already closed on 140, is we're saving about a third of it for deep back-ons into the B and C and D rounds. And I think it's going to pay off. It might lower our IRR, I'm getting a little bit detailed, but the cash-on-cash return, for every $1 million you invest in my fund, I'll try and give you 2, 3, 4 million back, that will be better. Okay?
But probably won't lower your IRR if the company is getting closer to exit.
That's the counterpoint. Very good. He's ready to be a VC. Okay. Now, so the other thing here, I'll give another metaphor. I like to talk in metaphors because I don't know all the data, so I cover it by metaphor. The issue here is, I say, like the sport of a late stage VC is kind of like an investment banker. It's surfing, catching the waves, a lot of volatility and trends. And what's the hot, cool thing? Because you have to get out. on time. You have to watch the timing. I'm a scuba diver. I worry about long-term drift currents, okay, and sharks. And the idea here is to not worry about the noise at the surface. Bet on the entrepreneur. Go with them, stay with them through thick and thin. And that's why you sometimes need a little bit larger fund and longer funding cycles, so maybe raise for 2 years worth of cash flow and burn rate rather than just 12 months, which was sort of the old just-in-time version. All right, little geographical stuff. I said we invest beyond, and it just turns out, luckily, we happen to pick the 4 that LPs tend to like too. No bias there, just luck. Here, for you, what are things that we look for? I think we're similar to most VCs. Bless you. We tend to look for this passion and commitment, a real persistence that you're not going to give up, because life is tough. Right? It was tougher in the 19th century, the 18th century, but we all live now. But it's very tough for entrepreneurs. Very rewarding and very difficult. It's a roller coaster. You get highs and lows, higher highs, lower lows. But most entrepreneurs are driven by their own internal motivation, which is so wonderful. And that's why I think we resonate with the other. And I think, honestly, I can be a better VC because I founded my own venture capital fund. So I'm also an entrepreneur in that respect. Does that make sense? Vision. You have to have something different. You have to see cross-eyed or something different, or have that super laser vision of Superman, or something different that people don't see. Everyone drives along and sees the same thing. You catch something else. I always compliment my little 4-year-old son, Rafi, because he's low to the ground. So when we're out mushroom hunting or looking for flowers or bugs or whatever, he always, or coins on the ground, he always finds them first. And I say, Rafi, keep that observation. That's great. Use that skill. You know, we lose it where you are. If you're 4 years old and you're close to the ground, use that. If you're a PhD in statistics, use that. There are a lot of skills you have. Focus on your laser. Next, credibility and integrity. No compromise. It just doesn't work. It's so much easier to be straightforward because we're going to find out. Or you're going to find out and not be able to want to live with yourself anymore. So, enough said. You've got to have some kind of domain expertise. Or maybe you're the producer and you assemble the team that does have that expertise. Right? You don't have to have it all. You're not a Superman, Superwoman. Just bring together a group that has credibility and can bring something to bear that makes the world a better place. I love this one. Thomas Sowell from Stanford over here has a wonderful statement about profit. What is profit? It's showing how well you've served your fellow human being. Nobody forces you to buy things, generally, except sometimes the government. But generally, people are not forcing you to buy anything. So people who compete for creating great stuff might be a lousy person. You might be really mean and crafty and have all kinds of bad ideas and bad motives. But if they create something great that a lot of people want and use and benefit from, then that's what profit is. It's a reward for value delivered. So we like that. Get some peer groups and mentors. I think one of the best is the YPO organization. If you're in it, stay. How many of you are in it? Anybody in YPO? What's it? Young Presidents Organization. It's not so popular here in Silicon Valley among the tech folks. It's more from a traditional class of entrepreneurs who run like family businesses and things. But I think it's great. And I'll give you a trick. We're doing it with our CEOs at the end of the month at our retreat. You get a group of folks together that commit to stay with each other for a period, at least a year, but preferably more. Some of these groups have gone on for decades. And it's usually between 6 and 12 people. And what they do is they have a confidential round table where they each can bring up their issues. And there's no shoulda. You can't point a finger and say, you should do this when they bring up their issue. You have a round of, this is my issue, this is what I'm thinking of some trouble dealing with right now. Everyone can ask a clarifying question. And then everyone can say, well, if they want to, in my experience, I had a similar situation, or this is something that I've seen that might be relevant. But there's no shoulda, because most CEOs know the answers. They just need to be unlocked, they need to work it, and they need peers to bounce ideas off of. So it's a great idea. So find either a buddy or a mentor group that you can work with. And that's awesome. And hopefully VCs can sometimes be that buddy for you. Not a buddy in the pal sense, but a person you can talk to about confidential, difficult, tough issues. I have to lay off folks. I have to raise prices. I have to do a down round. All these things that are tough.
Mastermind group.
Question?
A mastermind group.
Mastermind group. There you go. Here is a way, just a little mnemonic, to think about what we look for as VCs. And if you're tweeting, you can hashtag out. the VC, six T's. And I think I stole this from Neil Weintraub, another great VC. First, we look for the theme. What are you doing? What is the problem that is being solved? Then the team, who's going to do it? Why are you the right folks? If you aren't a complete team, tell us where the holes are, and often we can try and help fill those holes. The terrain, that's a T word for market. What is the market you're going after? Why is it attractive? Who are the competition, etc. Then the terrain, then top technology, how do you do it? What's the secret sauce? Do you have some barriers to entry that make it particularly hard to copy or catch up? Timing, this is what's going on in the market. Are you early to the market? Are you late to the market? You have to do education, prospecting, catch up, first mover advantage, all that stuff. And then do you need to use channels or do you go direct? All that kind of stuff on the timing. And then terms, how much money do you need? And what other points are important to you in negotiations? I look over at my counsel over here, Mr. Zellinger, distinguished attorney who knows how, and you must have a good attorney with you. If you have a lower level cheap attorney, you will pay for it in the end. Much better to get a really good one. Steve is, he's not asking for a commercial, but I'm just telling you. I don't even know if you practice law anymore, but okay.
Always ready to help.
Always ready to help. Get good counsel, really good. We want good counsel. We want you to have good counsel when you negotiate against us. It makes our life a lot easier. Okay, those are sort of the six. Any questions on that? Okay. Next, due diligence. This is what we do. And here is where we do trust, because we like to trust you, but we have to verify. We have a fiduciary duty. It's not all our own money. It's some of our money in the fund, and then it's a lot of other people's money. So we have to take this very seriously. So we don't take anything for granted, and we don't expect, we expect the unexpected, and it happens. We find all kinds of crazy stuff when we start uncovering the covers or looking under the hood or whatever you want to metaphor is. We do a lot of market checks. We're blessed at Blumberg Capital. A lot of other VCs do similar things. We have a CIO council, Chief Information Officers at Fortune 500 companies, Chief Marketing Officers, and Chief Security Officers. And we talk to these people on a regular basis. We got tonight in New York, as we're by meeting, they're having dinner. We had one Monday in San Francisco. And we get these folks together from Merck, J&J, Ford, 8 American Airlines, big groups. And we sort of ask this question, if we build this, would you buy it? Very useful for them, because they don't get to see a lot of startups. They're too busy, they're too high in the clouds. And so we bring them down to earth and show them how fast the world is changing underneath. You know, they're flying at 64,000 feet at 300 miles an hour, and we say, hey, down on earth, it's moving even faster. So they like that. And so we do those kind of customer checks with them and many others in our network. And then we do founder checks on you. And you should do founder checks, you should do VC checks on us. Who's going to be on my board? How have you helped the entrepreneurs before you? What happens when things don't work out? Where are you in the life cycle of your fund? There are a lot of things you as entrepreneurs need to know about us, because it's always good to ask a salesperson, how are you compensated? Because then you know how to work with them. And you should know how VC's compensated and where we are in our funding cycle, so that we can do best by you and you do best by us. This is about transparency, big fan of transparency. And then there's financial checks and all that. That's less important in the early stage, because most of you don't have a balance sheet worth commenting on. In the later stage, it gets much more deep into the numbers and all that stuff. Not my expertise. And then legal stuff. I've talked about that. Questions? Okay. Yes, sir. Yes, sir.
How do you do customer checks when it's B2C? Do you have startups that have actually had some
great.
traction?
You were paying attention.
Yes.
I talked about our CIO council, which is very enterprise-oriented. B2C, and Clarence has a solution that'll be, I don't know if you want to talk about it, but mostly people look at traction as one of the big things. And if you don't have traction yet, how do you figure it out? Some VCs are just great, intuitive people. I'm not necessarily think that I'm one of those. I'm a bad consumer. I don't really like popular culture. I don't really like popular stuff, so I'm a bad one to test things on. So I try not to trust my gut on consumer things. I would trust teenagers. I would trust other people who are out there. And so we have our go-to people in that realm as well. But I would mostly rely on you. Bring us the data. Think about it. When you're pitching, don't make me have to figure it out. Serve it to me on a platter, warm and ready to eat. Show me why it's going to work. Demonstrate it with anecdotes, customer, one who's representative of a class, or a distribution deal that's going to get you to one-to-many, things like that. Am I answering your question? All right. Post-investment support, what do we do? These are the kind of things we should do. Later stage VCs will do a lot more like in financial engineering stuff, and you can get debt and all that if you need that, but we think mostly what we're gonna help you do is get early sales and business introductions, recruiting of team, and help with the next round of financing. Because we know most of the big VCs around, I think they respect us pretty well. We're seen as a classic, good, solid early stage guy, and so we get the early stage deal flow often with angels. And then we bring things up to the bigger folks, mostly around here on Sand Hill Road. The 3 or 4 areas here, we're starting to bring vertical domain expertise into our fund. So we've hired a woman named Julie Hecht, who's in-house full-time on recruiting. And all she does is help our portfolio companies for free to find talent. And then we're hiring a person for business development. And then we're hiring a person for marketing. Same thing. They'll be available to help our portfolio companies. Andreessen has been doing this for the later stage companies, less so for early. We are focused on early, and so this is the kind of stuff we're going to be doing. And then most of us have operating backgrounds. At Checkpoint, one of my colleagues at other places, so we've been there, been in the trenches, understand how to do business development deals, or at least a lot of mistakes we've made, and we try and show you how to not make at least the mistakes we've made. Follow-on investing based on merit. That's not always a yes. Sometimes it has to be a no, and I think you understand the point. Now, there's a lot of accelerated risk, and I'm going to go fast through this because I want to get more to your questions, but we're just getting started. The world is, remember we saw that curve? It's going to continue to go faster because of some of these things. The impact of the digital mobile revolution, McKinsey, who knows all, says 5x the internet. Okay? Pretty exciting. I think things like synthetic biology, the 3D printing area, they're IoT, Internet of Things, giant new whole domains, of which I know little, but I know they're going to be big. I would say this is very true. Almost all business models are at risk. And I think somebody said, it's not here yet, 40% of the existing large companies will fail. Just like a lot of the railroads thought they were in the railroad business instead of the transportation business. You get the picture. People will miss it again. And Clayton Christensen has probably some of the best stuff on this in his couple of books. I think The Innovator's Dilemma and The Innovator's Solution. He's a couple of them. And here are some sort of boilerplate buzzwords for interest. So I would say, carpe diem, let's seize the day, let's go out and do it. The developed companies, the developed economies have very high consumers. This was meant for a talk that I did in Europe, so I'll tailor it now back to here. If you were, say, coming from Europe, how many of you come from, say, Europe, developed countries? How many of you come from developing countries? And how many here in the US? Okay, most of us. All right, so we got 3. So if you're in the developed countries like Europe, when I was giving this talk in Amsterdam, basically they have rule of law, low corruption, okay, but relatively low growth. Developing countries have sometimes the opposite, but super high growth, more corruption, less rule of law. So you got to balance those things and what your market's going to be. There's natural trade bridges, of course, here. In Europe, again, strong digital mobile infrastructure, but now let's take to the developing countries. They have the whole greenfield economy. They don't have any legacy infrastructure, so they can move and leapfrog bounds. It's much easier to do things in some of those places. So you might say, oh, I should launch in the US because it's an early adopter. Well, maybe, but maybe it's better to launch in Korea, where the bandwidth is, amazing. You got to have leading research institutions that we're blessed here in the Bay Area, across the US. Israel has some great ones, Europe does. East Asia is starting to have some as well. So that's important. And then world centers for finance, logistics, manufacturing. Those are places, especially in Europe, again, where this was given, but look for your own market where it's going to be right. And I'm going to do another thing here, polyglot. It's extremely important to have a diverse set of eyes and ears and brains contributing to this. And that's one of the blessings of the Bay Area. We have so many interesting people from all over the world that bring their brain power to do it. And some countries that have just monocultures maybe will stagnate a little bit. And I think that's a risk. I don't know, it's not for sure yet, because say China, which is pretty monoculture so far, it's been taking the brick off of the spring, right? Getting rid of communism was like taking a brick off of the spring mattress. And it's been rising, because essentially, as some economists say, they've been doing a tax cut every year for the past 30 years. That's what getting rid of communism is. Because remember, when 100% of output goes to the government, that's 100% taxation. And you keep lowering that and letting more and more go to the private sector, you're lowering taxes. India doing the same thing, under Modi, etc. So it's very exciting to see that happening. I wish our guys would get that message here, but I don't know. And then I think, again, too much government intervention almost everywhere on earth. Entrepreneurs don't need help. I, as a VC, I don't want subsidies. I don't want support. I really don't. I just want you to get away from me. And there's this wonderful line from Fiddler on the Roof, where this poor Jewish peddler is asked, he asked the rabbi, is there a blessing for the Tsar? And the Tsar, no offense to the Tsar or any Russians here, but the Tsar was pretty oppressive to the Jews. So the rabbi says, yes, my son, there's a proper blessing for the Tsar. And I'll now say it for government from Silicon Valley. May God bless and keep the government far away from us. That's it. Changes. Mobile. Everywhere. We used to have a mobile sector. Now every part of every company has got something mobile going on. So it's there. Crowdsourcing is not just crowdfunding. A lot of people the press focuses on crowdfunding, but I don't know why. There's so much more to the crowd. Think about Waze. How many of you use Waze? W-A-Z-E? Oh, okay, many of you. I used it to get here. And the thing about Waze is that individually, that data on your mobile phone of where you are at that time is useless. Collectively, it's priceless. And that's the problem that Uri Levin solved. He said, I hate getting stuck in traffic jams. And I know where I am. And if I could know where everybody else is, it would tell us roughly where we are and how fast the traffic's moving, and where it's slowing down because there's a crash, et cetera, et cetera. You get the picture. So then, he's come back to us now, and we've now backed 3 more companies for him. And I'll just go quickly back to those. I think some of them are on this page. Yeah. We've backed one called Zeek. And what Zeek does, and this is useful, if you're flying first or business class anytime soon, long haul, we think we can save you about 20%. Here's how. On their app, which is not available here in the US, but so far only in Israel, soon here. Wait, I'm talking about Zeek. I'm sorry, different one. I'm talking about Fairfly, this one. I'll come to Zeek in a minute. But this is one of his. So Fairfly, basically, from the time you book a ticket till when you fly, the volatility in pricing is about 25% on average. And these super brainiacs from the Israeli military intelligence have reverse engineered the pricing algorithms of most of the airlines. So what they do is when you buy, they figure out the nadir, the low point. They text you, Mrs. Smith, would you like to rebook your flight first class to Hong Kong, round trip, and at a 20% lower price? And you presumably say yes. We hold the new one, cancel the old one, use your credit card to book the new one. The airline doesn't even know we're involved. Sweet.
What about cancellation fees?
Well, for first and business class, there are very few because they want to keep you, right? So that's why we've targeted only first and business class, because the deltas are bigger there.
Yeah.
It could work on anything. The way, and it's a funny story, everything should have a funny story. The way he found this was he was going to take his family on vacation from Israel to Greece. And he booked the hotel, and he had a big family, 10 people. And he said, wow, it's 170 euros per night per room. Okay, I can afford it. And then the Greek crisis happened. Things crashed in Greece, and he was like, oh, I wonder if the hotel's still there. He looked on the booking site, and it was suddenly it had changed, it was 170 euros per week per room. He said, I'm going to rebook that. And so he canceled, and he rebooked, saved 7 times. And then, just for giggles, he checked the night before he flew, and it was 170 euros per week plus free breakfast. And being the good economist that he is, he rebooked again. But he said, why should I have to do this? I want a little guardian angel sitting on my shoulder, metaphorically, or on my phone, that will watch and cover my back, get me the best deal possible. So that's what we did. And we started with airlines, but it can go to hotels, and rental cars, and maybe medical procedures, and law firms, and whatever. Have your back. That's Fairfly. Then Zeek. I got excited about Zeek. Zeek is not such a problem we thought in the US. And so as a VC, I thought, oh, this is a big problem in Europe, Asia, Latin America. And now I think this is going to also be super successful here. What Zeek does is, again, crowd sourcing of information, making the power of the crowd that individually we're weak, together we're strong, and information transparency helps everybody and helps capitalism be fair and good, is when you have a store credit. I'm taking no offense to IKEA, but say we get married, right? And you give us a $500 gift certificate to IKEA. I say, darling, here's the IKEA. And you say, I hate IKEA. I don't want to furnish. She does. Hey, no offense to IKEA. But what happens then is that sort of gets lost. Now a lot of people say, oh, that's breakage and IKEA loves it because nobody ever redeems it. Actually, IKEA would rather have people come into their store with coupons. Because with coupons, people feel it's like monopoly money and they spend 1.3 times the amount of the face value. So here's where Zeke comes in with the genius. They said, let's create a marketplace for a secondary market of these coupons and credits. So we would take our $500 gift certificate, put it into the market, and in Israel, where this got going, 85% of the time people sell at 85% of par value in a day and a half to 2 days. Whew, that's liquidity. Now with that liquidity, retailers like IKEA said to us, gee, that is so interesting because for customer acquisition, what we could do is print coupons, not even sell them, just we'll sell them to the market at a 10% discount, 100 euros or $100 per, and we'll sell them to you in the marketplace for 90. And then when anybody comes into our store with one of these coupons, we'll know they cost us $10 or 10 euros to get into the store. And then they're going to spend 130 while they're here. Sweet? So that's the. And the third one that he did, this is one man thinking of problems. He has a t-shirt that says, the problem is more important than the solution. Look for problems if you're an entrepreneur. It's a great way to go through life. And Shimon Peres has a great thing to tell you about the Jewish people. He says, we are the people of dissatisfaction. We're dissatisfied with the status quo. And if you are Jewish, you know this is true. We don't like the way it is. We want to change things and hopefully make it better. And so you should be an entrepreneur and be dissatisfied with the way things are. So where's the other one? FEX. Okay, how many of you have a 401k or an IRA? You're getting screwed. Okay, do you know how you're getting screwed? Do you know what your fees are? Does anybody know exactly what fees on average they pay every year? You do know. No, most people don't know. But I'm going to say this. Shame on you. And shame on me. I don't know either. None of us do. We're ignorant consumers. And it's the largest asset most of us have in our lifetime. We should know what we're being charged for the retirement fees we have, which we build up over 30 or 40 years of a work lifetime. So what FEX does is say, let's level the playing field. Why should, no smears against Fidelity or T. Rowe Price, where I used to work, any of these great firms, but they know a lot about you. They know how to charge you all kinds of different fees. And what do we know? In Chinese we say, bupkis. Nothing. We don't know much about the fees. So the fees are made transparent by FEX instantly. You just plug in your credentials. We instantly decipher all the 70 pages of details for you on your IRA and 401k plan, and we show you what you're being charged and how you, compared to other people in your same socio-demographic, can do better by saving at maybe the same institution by changing share class or moving to another one. And just right here in the Valley, we just did a thing with Intel, and again, hello Intel, come and talk to us. We found that Intel, which pays 75 basis points on its 401k, is a great corporation. But there are many corporations doing 401ks for better. There are other ones like Qualcomm that are paying 45 basis points. And you take the delta between 75 and 45, and you take it across all the Intel employees, and guess how much they can save? $4 billion.
Yes.
Okay? So this is the kind of thing that capitalism and entrepreneurship can do to help everybody do better. Capitalism is not about helping big corporations and rich people do better. It's about helping everybody do better. And that's what you guys do. Be dissatisfied, fight, and make it a better place. Let's see, we've done this. Last one. Oh no, I'm gone into the desert. How do I get back? You didn't do that? Well, it's beautiful, but is there a way to get back onto the screen? What I was going to show you, if I can't do it, is a gauge of happiness of the world. And it shows that happiness is actually somewhat correlated with wealth, GDP per capita. It's not to say that rich people are happier than poor people individually, but on average, being poor sucks. So the idea is that poor countries, a lot of them in developing countries, I don't know, pick Sudan or some places like that, and then the richer countries up here, Norway, Switzerland, et cetera, there's a curve of happiness that goes like this. And it's a pretty strong correlation. And so it's not just about dollars, it's actually ultimately about, the Dalai Lama was asked the other day, what is life about? What's the point of life? It's to be happy, and to make other people happy. Well, that's hopefully, I think, what all of us can be doing. And here is an example of it. There it is. Okay. Ta-da! And this was done by some smart people. Actually, Justin Wolfers. I know him. Anybody know him? He's Australian. He was at Stanford. Now he's at work. And this is about making the world happy, measuring satisfaction with their lives. And it shows that, again, if you're in a wealthier country, not the wealthiest. I mean, Ireland is not the wealthiest around, but they're happier than people, suffering in Togo or Zimbabwe for maybe some obvious reasons. So this is our mandate: make the world a better place. And we're in Silicon Valley where we know how to do it. So with that, I'm going to stop and say to you, we fund a lot of companies. We're hiring companies, so we want to fund you, we want to hire you, and help you in any other way. And now, I want you to help me by asking questions. If you don't, I'll start calling. Yes?
Hi, David.
Hi.
I'll just give you a microphone. You can speak into the mic. Yeah.
Is that on?
It's on.
There's a small space anyway. So thank you so much for one for presentation.
My pleasure.
Do you guys have a special sort of focus, industry focus? Because my understanding, based on what I read, you have invested quite a few fintech companies.
Yes. The lady's asking if we have a focus in domains where we like to invest. And I said we have a stage focus, which is seed and A, where we like to jump in first. So don't bring us a Series D and say, oh, it's going to go public tomorrow. And we like multiple geographies, so we're not restrained to just Silicon Valley. Remember the arrogancy of the people who used to say, I only invest in companies that I can bicycle to. There were a lot of VCs who said that.
Yeah.
How freaking arrogant is that? There are brains all over the world. And the arrogance is not just that they don't want to fly, it's that they think somehow they're so important to the success of that company. Here's our model. Many VCs have what I call the marionette model. We, the VC, sort of have you on puppet strings, and we pull you and we push you and you do our little dance. The Blumberg capital model, I think the new model, which in terms of trade have changed, and we're not so doing this out of just because we're great, nice, super wonderful people, I think it's in our self-interest, is that the model is you drive the Ferrari, we're the pit crew. I call it the NASCAR model. You are the change makers, we are the support staff. You do the big change, you take the big risks, but we're there to change your oil, fill your gas, get fans to the stands, raise the pom-poms, and since we've been around that track about 20,000 times, try and give you a heads up because you're about to crash. You're heading at, sortie speed. So that's our model, and I think it works better. I think entrepreneurs get along with us better because we don't think we own them. It's a marriage, we're working it together. Yes, next.
So would you invest in a
Oh,
startup?
but you know what? The lady asked the question I didn't really answer. I got off into one of my famous segues. Let me just answer it. The domains that we're particularly strong at right now, and this will change. 4 or 5 years ago, we didn't have any companies in financial services. Today, we have about 25 companies in financial services. So we're extremely strong there. I think probably we have the strongest portfolio of any early stage fund that's not owned by a bank or, well, banks can't own. Again, dear government intervened and said banks can't own venture funds anymore for some systemic risk reasons of unknown nature. And so we like that area for financial services, but let me go more broad. The broad theme is that if I take 300 years of economic history in 1 minute, I like to do these kind of broad sweeps, you'd have to say that the 19th century, the big game changer was that we went from human and animal power to steam, locomotive, and mechanical and electrical power in main domains of agriculture, mining, and transportation. And if you mentally think of how we transport ourselves before and then after, you understand it. 20th century, fixed manufacturing. It like went from cottage industry to robots in Japan, China, US, Korea, Europe, pretty steadily. 21st century, what's it about?
Information.
Yes, and information in services, the service economy. Service economy just 3 or 4 years ago passed 50% mark of total GDP in the world. In the US, I think 70% of our population is engaged in service economy work. Who knows other than Steve Berlinger, because I bet he knows. What percentage of the population was engaged at the time of our independence in agriculture? 1776. What were we all doing? 95%. Agriculture. Now how many? 2%. So, this is a lesson. All those people who carp about, oh, we're losing jobs. Baloney. We lost 93% of jobs in agriculture over the last 200 years. We are wealthier, we eat better, we export more food. Our food is healthier, safer, better. It's just a fake argument. Because we get richer, we have more demands. Demands are practically infinite. Human needs are practically infinite. So we have more demand for higher level consumption patterns, etc. So we all moved out of agriculture. By the time of the Civil War, about 50% of people were working in factories. Okay? Now that's down to a very, very small percentage. I forget, it's double digits, but low double digits work in factories now, manufacturing. Most people work in services. And that's where the economy of what you're doing, you said information, that's right, because what do services depend on? Two main things. The information, and then the other part I thought was so crucial in growth, the communication of the information. And it rides on infrastructure. So Moore's Law has been helping us get smarter and smarter processing of the data, and now social networks and the mobile phones get us to distribute it through the internet, etc., and Wi-Fi and Zigbee and everything else, and that helps remember the multiplier effect of information grow. So the services economy is where it's at. I think I'm also big on the physical world, so Internet of Things, which is information too. And there's all kinds of new stuff in composites and printing. So I'm not saying that I'm against atoms. People say, you've got to focus on atoms, not just electrons. I'm for both. But I do think our fund is typically focused on the electrons, the information side of it, and the communication side. And so that's where we see a lot. So back to domains. Financial services, very disrupted and disrupting right now. And it's kind of, if you don't join us, we're going to beat you. So if you can't beat them, join them, say the big banks. Then there's security. Security is one of the gifts that keeps giving to venture capitalists and entrepreneurs, because as product cycles shorten and new platforms come out, new bad guys come in to try and attack us, and we need to defend ourselves with ever new sets of behavior. I saw this first at Checkpoint. The Checkpoint has a funny story. The first minute we plugged in our software at a beta site customer, this happened in Israel, they called us, and we were driving back from, the founders were driving back to the headquarters, and they said, what's wrong? Is it like a problem? Did it bug? I said, no, we've been hacked already, like instantly. And the thing was that it was already happening. People just didn't understand it. And you have already been hacked. You just don't know it yet. So we're investing in a whole category of new security companies that are monitoring ongoing basis what's going on your network, because no longer is perimeter defense good enough. Right? You have to be defending all the time. I'll give you another example from our portfolio, a company called BioCatch. Remember how many people have done tokens or CAPTCHA or an RSA token or fingerprint ID or an iris scan? You think, okay, now I'm safe. You're safe for that instant it knows who you are. But there's something called man in the middle, and there are other kinds of attacks that, like, after you've logged in, they've stolen your credentials. So what good security is that? So what BioCatch does is it takes a composite of 400 data feeds from the way you move your mouse, the way you type, the cadence, the pressure, the spacing, the words, and the way you hold your phone and talk. And all that is reduced to a single footprint of you that's unique. And we even know when you're drunk or on drugs. But it's still you. And your mama may not know, but we know. And so what that does is it protects the bank. For example, you're having a transaction, you say Wells Fargo, we know that it's you all the way through the transaction, which is not just guarding you at the gate, but all the way through. So this is the kind of thing we like to think about. So bring a solution to us, something like that. So information security, financial services, big data, of course. We say we love algorithms. If you have a great algorithm, oh, that makes us excited. Yeah, we love that at Blumberg Capital. Other things I think we've done really well in social media and ad tech. I'll give you another fascinating example, a company called Double Verify. They found a problem, again, dissatisfaction. The entrepreneur was sitting at his desk, and he was sitting in Tel Aviv, this is important for a moment, and he was reading the New York Times. And he saw an ad for Target stores. Target, as many of you know, only has stores in the United States. So he thought it was odd because the New York Times server would see that he's an IP address in Tel Aviv. Why would they serve an ad for a domestic US retailer? Waste of the advertiser's money. So he said to his wife, hey honey, I think Target's coming to Israel. And she said, grow up. And he checked out, and of course she was right. That's why I almost always are. And what happened is that the New York Times ad server had just said, let's sell some more ads. They didn't really care if their advertiser was getting value. So he started checking with his friends at the advertising agencies, and they said there are worse problems than that. We're having brands, and I won't name them now, but really big Fortune 10 companies, brands appearing on neo-Nazi sites and porno sites and Ku Klux Klan sites. And this was getting up to the board of directors. People were very unhappy. Social activist groups, churches were saying, why are you advertising on the Ku Klux Klan site? Big phone company X. And so Little Double Verify came into existence, and what they did is they became the best friend of the advertiser to patrol and see that they were actually getting the ads placed where they intended them to be placed. Pay for what you get, or get what you pay for. It's a whole new category. People didn't even think about this initially. And now, one of the biggest issues of fraud in the industry is video fraud, where bots click on videos, which have super high CPM advertising rates, and these bots are making tons of money for some mafia somewhere, and nobody's seeing them. Or they're the ways of doing a pixel by pixel resolution display. So your ad is appearing, and nobody can see it. All this bad stuff going. So security, again, has tons of opportunities. Often they're niche, so we like to find bigger ones that can be platforms. And then let me go on to e-commerce. E-commerce is huge, and international e-commerce is the most important part of it. It's the fastest growing part of e-commerce. So we love payment schemes. We're doing a lot in that realm. We're doing a lot, which is sort of related to financial services, but it ties to e-commerce. I would say marketing automation, super important. The marketing jobs of today, of tomorrow, will need to have backgrounds in statistics and math. No longer is English literature and poetry going to be enough. Shame, because people should have English literature and poetry, but you need the math and the statistics as well. Areas that I don't know about, but I think are going to be very exciting, we're open to them, so please bring them. Things in the digital biology area. We just invested in a company from Y Combinator called 20N, which is an amazing idea of using deep learning algorithm to find new pathways to create compounds. So the first test case was GSK, the pharmaceutical manufacturer, brought us the question, please make acetaminophen in a cheaper, faster way, not from phenols, which come from oil. And if there's any scientists around and I'm making a mistake, I apologize, I've garbled it, but I think that's the story. And they found pathways by finding a gene from a fungus, putting it into another microbe, and it sort of spits out, ultimately, acetaminophen in a cheaper, faster way. And this is the way we're going to be able to create not only existing compounds, but whole new ones. Very exciting what we're going to move into. So we're open for things like that.
15 minutes.
15 minutes, okay. So did that answer some of your questions? Okay, and now Clarence, back to you.
Yeah, so would you invest in a startup software platform whose primary business model might ultimately become a fund itself?
Good question. What's the exit?
That lies the problem. If it becomes a fund itself, it'll be structured as an LLC so that there's flow-throughs, and it won't be a typical 10-year exit horizon, which is the horizon of the fund.
There's the rub for me, because my investors eventually demand their money back. Usually it's a time horizon of 10 years.
You sell your position.
We could sell a position, and that's very interesting. So you allow me a new digression. Again, government tried to solve last year's problem, which is 20 years ago, Sarbanes-Oxley, in response to the Enron crisis and I think MCI, there was a bunch of corruption crises. And they thought, okay, let's put a big blanket of regulation on everybody to try and find the bad apples. Well, sometimes it finds the bad apples. Remarkably, still bad apples happen, but it costs everybody a lot of regulatory cost. And that's the problem about regulation. It is not free. I'm not against all regulation, but it's not free. Okay, when we think we're solving a problem, we're imposing a cost on everybody else. So what happened with Sarbanes-Oxley and other rules is that it costs about $2.5 million just for the legal and accounting stuff to get ready for an IPO, and then another $500,000 a year for that. And somebody who's in the accounting industry can give me the latest figures. That's from a few years ago, I think, by Silicon Valley Bank. So if you have $100 million in revenue and $10 million in EBITDA, and you're going to spend 3 of it the first year to get ready to go IPO, you've lost 30% of your market cap because you got a 10x multiplier. How crazy is that? So what it did is it caused a lot of VCs and founders to say, I'm not going to go public so early. I'm going to wait. So the effect of this regulation, which was meant to help widows and orphans, meant that VCs and entrepreneurs got richer. And people who were buying in the public market, like T. Rowe Price and Fidelity and Vanguard and these institutional mutual funds, had to buy much later into the cycle after a lot of the growth had already gone. How'd that work out? Well, the point to your answer is that the interesting thing is that the market responds. It's very intuitive. It's very innovative. And so what happened with entrepreneurs is we said, let's find liquidity another way. Hence the rise of the secondary markets. Share Post, Second Market. These groups have come to the fore, and you're seeing an incredible amount of trading. And a lot of you know Hootsuite. Well, Hootsuite's a fascinating example because Blumberg Capital wanted some liquidity back in the day, a year and a half ago, and there was a lot of demand for the next round of financing. Axel, Insight, and Omers, and a bunch of other funds were buzzing around wanting, there was more demand than the company needed for its own primary share sales. So we stepped up and sold part of our position. Hearst sold all of their position. We had different risk profiles. They had more risk factors on the company. We thought less, so we held part of our position. Good thing we did. The first part of our position, we made 52 times our money. Okay, no one's going to complain if you make 52 times your money and then take some of it off the table. So that's what we did, and we held on to another big chunk, which is now going to get 70 times its money or something a few years later when that company goes public, God willing. And so that secondary market and liquidity is impressive. And so you're saying potentially we could sell our position. So then I get more interested in your solution. And by the way, he pitched me something that I thought instantly it has something. You want to tell folks what it is?
Sure. So yeah, I'm
And
working
just
on.
see how many folks would be interested in using it.
Okay, yeah, so as an entrepreneur who've done a couple of startups, the most painful part of doing a startup is pitching investors very early, right? And the funding environment has changed, especially over the past 2 years post-Color. Anybody remember Color?
Oh, yeah.
Company around the corner? Okay, so now if you pitch investors, they all want to know one thing. What kind of traction are you getting? Because it's so much cheaper.
In the consumer era.
Yeah, absolutely. And so, because it's become so much cheaper to build a startup, there are 100 times more startups hitting the market. So investors have gotten wise and started taking a wait and see approach. Let us see the data. Had you seen Uber's early data in 2010, it would have been a no-brainer because traction is like porn. You know it when you see it. You would have put as much money as you possibly could have in that deal. So what we're doing at venturefund.io is we're creating a two-sided marketplace where instead of pitching investors, you let your data do your pitching. So you connect your app using our Traction API to a dashboard that reports your metrics, and then you choose which investors you want to share your traction with, so that when your traction grows, they pitch you. So that's the model, but it's free for entrepreneurs and free for investors, and we'll figure out other ways to monetize later, probably becoming some sort of a fund ourselves, almost like what AngelList is doing.
At the risk of making this a little bit R or X rated, it's kind of like a private lap dance for the investor. Yeah, I like that. Good. Next question. Yes, ma'am.
Tova, I just came back 6 weeks ago from Israel. We went on a delegation hosted by the Ministry of Foreign Affairs. It was a life-changing experience for most of us. There were angel investors, there were lawyers, there were technologists, entrepreneurs. But one thing we all came back with was just the different type of innovation we saw in Israel as opposed to Silicon Valley.
How so?
I think it was an innovation that is perpetually not just trying to solve the 25-mile radius that we have here. I think it was it's software is great here, and I'm so happy to have lived here most of my life. But I think the innovation I saw in Israel was impressive. It's almost changing whole industries of itself that I would have never thought were coming right now. And one of them was SIO, with just a modular sensor. So you just point it to any type of matter, and it comes back and gives you the identity of the matter.
Yes.
And I didn't believe until they actually
Consumer physics.
Yes.
Yes.
I didn't believe until with Yael, I didn't believe until they pointed to the apple and then gave exactly the composition of the apple and the calories, which as a woman I really cared about.
Yes, to explain what this is, I saw this at CES last year, and I was so excited, and I went to this VC dinner. I said, everyone went around, what's the most exciting thing you said? I said, this is the most exciting thing I've seen. You point it at your plate of food, and it tells you the ingredients of the food. And it can tell you the calories, and it can tell you the allergens or whatever. If you're allergic to cashews, like my little kid, it'll show there's cashews proteins in there, et cetera, et cetera, et cetera. How much fat, it's amazing. How?
How does it do that?
I don't know, probably spectral analysis. Ooh, that was a good guess. Okay. But that's the kind of thing you see there. Now, one thing about Israel that is somewhat unique, and I'll try and explain why. Israel is no market. They have to look outside. So that's a good thing. And sometimes countries in Europe, which are kind of medium-sized, get kind of like, I'll call it fat and happy, And the governments think they're helping them with a lot of protectionist rules and say, oh, if you sell within our country, we're going to support you. Bad idea, because you never become fighter world class. You got to fight world class. The world is very Darwinian. And consumers, ultimately who are the choosers, or big enterprises who are buying the product in the enterprise world, are going to demand best class. So they're going to fight, and if you don't fight at world class, you're going to lose. So Israel has to always fight at world class because there's no local market. That's number one. Number two reason Israel has that is that there's a very select, interesting training unit, which we don't have in the US. I don't think we can. That's because of the military. They have a draft.
Yeah.
Every man and every woman, with a few exceptions, goes in. And the Israeli military is smart. They pick the top brainiacs, mostly in the sciences and math and physics, and they put them in the special units. And they give them special training. And they'll take 3 people, maybe you know physics, and you know math, and you know computer science. And they say, the 3 of you are going to build this new radar system to protect our borders. And here's your budget, and here's your deadline, and your grandmother's life depends on it. And these guys, when they get out of the service, men and women, they feel so empowered. They feel bonded. They feel like they've done something really strong and important. And then when they go to university, they're not just like kicking back 6-packs and running around acting crazy. They're much more serious. They've seen life and death, and they've seen an accomplishment of them personally in the professional sense. And they say, instead of going out and saying, well, what do I do now? I guess I'll go to law school. No offense to law school. Or I'll go to, I don't know, something. They say, I'm going to be an entrepreneur. I can do this. And I got my buddies. And they've got my back. And I know how strong they are. And I know their diverse sets of skills. So you get a lot of what I call estuary action. You know, the ecosystem estuary metaphor, I'm kind of a nature boy. That's where all life is created. Where the salt water meets the fresh water. At the edge of the prairie, in the shade of the forest. At the edge of the savanna, near the desert. That's where interesting things happen. So if you know physics and you know math and you know biology, wow, some cool things happen. So in Israel was where the place where the Given technology was created. You know, Given, G-I-V-E-N, Given imaging. This is a pill with a video camera inside it. You swallow it, and it takes a video of your GI tract so the doctors understand whether bad things are going on. Amazing mixture of technology. So those are the kind of things you see there. And I would like that to happen in the US. I think Silicon Valley is even stronger than Israel in many ways. I think so. I think Israel's next on that sort of status of innovation places. But Silicon Valley has so much more intensity and depth and history of it that we have. And we also have here a lot of big companies which are important. The Facebooks, the Googles, the Microsoft, the Suns, you know, all that is really important. AT&T. Think about the engineering horsepower that you have here at AT&T, and its diverse subsidiaries all around. So that kind of support structure, they don't have much of in Israel, but they can tap into it. And that's the nice thing about being global. Most of the multinationals in the world are the best NGOs ever. Multinational corporations should be prayed to and thanked by people in the world for doing so much good in the world. I don't work for a big multinational. Nobody needs to pay me to say this, but the multinationals of the world have done more good to help more people by bringing standards of excellence, technical training, good products, rules of conduct, etc., all around the world into hundreds of countries. It's a great thing. So, long discourse. Steve.
5 minutes, David.
5. Hello.
What an excellent, really great storyteller. Who knew? So, would you be kind enough to help us benchmark? If I'm an entrepreneur and I have my own little startup, when is it right for me, or maybe more importantly, when is it not right for me to call Blumberg Capital or Blumberg Capital?
Oh, great. Okay. That's a nice softball. Thank you. When should you call Blumberg Capital? When you want the finest venture capitalists in the land. Early stage. We want seed and A. So we say nothing is too early, but be smart for yourself, as Steve was asking. Get something that's going to impress us.
Once you have traction.
Or there's other things. There's not just traction, there's credibility that's so powerful. And I'm going to give you the example of our big hit. A big hit in our portfolio is a company called Nutanix. How many of you know of it? Wow, good. Nutanix, storage virtualization, giving EMC a run for its money. And these guys came from Google and Oracle and Astro Data. And they had seen how Google scaled. And one of the guys that helped write the Google file system, probably world's most popular program in software. And they said, how do we scale everything architecturally in a non-linear fashion? And they said, wow, hardware is getting cheaper and cheaper and better. Let's use commodity hardware instead of expensive custom hardware on storage area networks. And so they said, we'll put all the smarts in the software layer on top. That's essentially what Nutanix does. Takes commodity hardware, delivers it as an appliance, and makes your storage a linear acquisition. Very bite-sized, easy, less management, faster, better, cheaper. Very simple story, brilliant. The company has done phenomenally well. I mean, we're the first investor, and our $3 million investment is arguably now worth about $160 million, and they're going to go public later this year.
That's a home
Not
run.
to say that. What's that?
That's a home run.
It's a home run. Yeah, it could return at least 2 times the fund. The whole fund. It's 1 out of 40 companies in our portfolio, and Hootsuite already returned half the fund, so it's a good time to be a VC. And that company came to us not with traction, but what they came to us with was this impeccable team, super crackerjack, and they'd gone to school with one of my friends at IIT, and I know how hard IIT is to get into, so they had credentials. They had domain expertise that they proved to us in the conversation where we've got some of our CIOs at big companies who were having problems with storage, and we put these 3 guys in the lion's den, and we had this CIO council look around and talk to them, and they said, if you build this, we will buy it. So we plunked down the first money. So they came to us with brilliance, and that's hard to find, and how to get time with us, that's hard too. Be introduced by somebody that we know, that's a good thing, typically. And find your way to us, LinkedIn makes that easy. Try and be differentiated. Unless you're in some very weird thing that nobody's ever seen before, like Laura saw this company, SIO, with this strange new sensor. If you're doing something in an area where there's a lot of noise, try and really show us why you're different. In a slide, show that slide that shows everybody else and you. That's important. Okay? Thank you for the good question. Now, quickly,
I
I'll do
think
rapid
we
fire.
need to wrap it up now.
Yes?
Yep. And
And-
maybe everyone can come and talk to you
Yes, of course.
personally, if that's
I'll stay
okay
around.
for a few minutes. Thank you so much, David.
My pleasure.
I actually learned something, which always signifies a really great talk, so I really appreciate it.
Thank you. Hope you all did good.